Have you ever heard the phrase, Warren Buffett has bought 1 million shares of S&P 500 and he has put a tight stop loss 20 pips below the current price? No, that's because he doesn't do that. And yet, he's a billionaire and you're probably still struggling with your stop loss strategy. A strategy that your broker promotes, a strategy that a guru gave you for some amount of money, a strategy that doesn't work. In today's video, I will show you why you should never use a stop loss. Let's start with the basics. What is a stop loss? Stop loss is basically an order that you give to your broker. If the price hits the specific level, it's your stop loss level, your position will be automatically closed. For instance, let's take this GDP USD position. Here I have a take profit enable. So let me click here, modify. Let me click here, stop loss. And here is the level that you have to put. You could either choose an exact price or pips, number of pips. So I will increase the number of pips here a little bit. So let's put 130 here, just 130, 135, and let's click submit. As you can see, this is the stop loss order. So now if the price falls to this level, my broker will automatically close this position. I don't want to use this stop loss level, so I will remove it. There is an alternative to a stop loss called trailing stop. A trailing stop is the same thing as a stop loss. However, there is one difference. If you choose a trailing stop, the trailing stop that you see right here can trail the price if it goes in your direction. So if the price here continues going up, my trailing stop will rise with it. But if the price goes against me, the trailing stop will remain stationary, and if the price hits my trailing stop, the position will be again closed. So why not use a stop loss order? One of the main reasons that you should never use a stop loss is spreads. Spreads will hunt down your stop loss level every time, every single time. And this is a perfectly legitimate operation by your broker. Most people think that when they buy a stock or a forex pair, they buy at the current price. Well, they are wrong. They're buying on their broker's ask price and they're selling on their broker's bid price. As you can see on my live platform, here are the two prices. Here we can see that now that is the upper price is the ask price and the lower price is the bid price. The difference between those two prices is called a spread. The spread is usually visible on your platform. So our current instrument is the GDP USD, and as we can see here, here it is. It's 1.8 pips. When you buy a GDP USD, your position will appear on the ask price, and you can exit your trade on the bid price. So this is why every time you create a position, you immediately start in the negative, because the bid price has to be greater than the ask price in order for you to turn profit. This difference or the spread can hunt down your stops. And trust me, most of the brokers are market makers, and they can increase the spread. What is a market maker? Market maker could be a bank, could be a brokerage, every sort of organization that can increase liquidity on the markets. So let me show you some examples. Now let's say that you buy at this level, and what you're taught by many gurus and maybe your broker himself is that you should put a stop loss right here, or a stop loss below slightly below the lowest point. And this stop loss is usually very tight in order to limit the risk. Stop losses do not limit risk. The only way that you can limit is by trading small positions. This is the essential part of my turtle trading strategy. I always use small positions, so even if the price goes against me, I can wait a little bit and make another position, which will decrease my average price, and I can turn in profit more easily. And so let's go back to this position. Now the price starts going down. However, during news events or early in the morning, this spread can potentially increase up to this level, and it can close your position. So you're basically using this tool, the stop loss tool, and you're giving another door to your broker so that he can take your money. Don't do this. Don't be naive. Furthermore, brokers know these stop loss levels. This information is on their servers, and they can easily manipulate this bid or ask price or the spread so that they can take out the stop losses and close their customers' positions. Don't choose stop losses, use smaller positions, and don't be greedy. Now, having said all that, there are alternatives to stop losses. You can, for instance, have a signal, have an alert that you can put instead of your stop loss, and when the price hits that level, you will be alerted and your position won't be closed immediately. And you can decide for yourselves if that position should be closed or not. If you like this video, make sure to press the like button and subscribe to my channel. Thank you and have a nice day.